What if sending money anywhere in the world was as fast, cheap, and borderless as sending an email? Well, that's the promise of stablecoins, crypto's answer to digital dollars. They're already moving trillions, powering remittances, and quietly disrupting Visa and the banks. But with governments scrambling to regulate and institutional giants like PayPal jumping in, stablecoins are no longer just a crypto curiosity. They're becoming a new foundation for global finance. In this episode, we'll be exploring what stablecoins really are, how they work, and why everyone's saying they may mark an inflection point for Web3. Alec, are you excited for this one?
I think I didn't see this coming. I think like a couple of years ago when we were talking about CBDCs, stable coins, and crypto, we were kind of bearish market, and it was like, okay, well, crypto is not going to get institutionally adopted anytime soon, and surely there's like no avenue for stable coins, and but CBDC seemed to be taking off a little bit, and then obviously we moved past the bear market, and it seemed like there was mass institutional kind of favorable treatment for crypto, and we're like, okay, well, if crypto's coming in, why does anyone need stables? But that narrative has shifted again. Like I did not see this coming, but all anyone's talking about on LinkedIn right now is stablecoin adoption by the big institutions.
Yeah, not that we only get our news from LinkedIn, but it does feel that way, right? It's like a a lot of noise is being made, and I've kind of come around it because I've always, for a long time, thought stable coins. Because again, you and I have been in the industry for quite a long time. Stable coins are not a new thing by any means. They've been around for years and years now, and a bit like NFTs, I was a bit surprised to see them getting global traction, people talking about them because to me they were like, well, they're cool, but they're a little bit boring. And then I've kind of dug into it a little bit more, listened to what a lot of the chat is about, and I think there is actually something really fundamental going on here. So yeah, we'll get to the bottom, hopefully, of why everyone's talking about them.
Yeah, I do get it. I think it's like you it's the promise of the kind of this differentiating technology that is crypto, that is these kind of like distributed ledgers, but applied in a more controlled manner, and like it's issued by one business, and there's someone that you can hold responsible if something goes wrong. But yeah, let's jump into it. There's obviously been a lot of headlines from the US. The same man is making ripples once again. Play on word there. And I think one of the big, like, do you want to start with some of the news that's come out recently? I think, and then maybe go into the why.
Yeah, I think it makes sense because we've obviously talked about stablecoins before. And so, why are we talking today specifically about them, the age of stablecoins? Well, yeah, the big news is that there's been some regulatory movement in the US. So, just last week, there was two big developments. One was the Genius Act that actually passed both the House of Representatives and the Senate and got signed into law. So that's one stablecoin specific piece of legislation that provides new guidance on how to regulate stablecoins in America, which is again huge news. It doesn't sound that exciting, but it's given the lack of clarity there's been in the industry. That's one of the big things. The second development was clarity itself. So there's another act going through. I think that last week went through the House of Representatives and will be going on to the Senate and potentially being sworn into law. So those two were the big developments last week that everyone's making a lot of fuss about. And I think maybe we will circle back to the specifics of those later, and then unless you have anything you want to get off your chest now, we maybe can dive into just a little recap and primer on what stablecoins actually are before we get to that.
No, I think you've pretty much like you've covered the main things. I think the fact that there is a framework, the fact that it seemed like it wasn't going to go through, then the man in the White House pushed it through. All of it makes sense. Like the idea of 100% reserves, it makes sense to strengthen the US dollar. But we can go into the specifics a bit later. Yeah, let's go into what is a stablecoin. I think maybe you touched on it a little bit at the start there, but like digital tokens that are pegged to fiat typically, right? So they combine a lot of the technology of crypto rails, but with fiat value stability. Like that's one of the things we've seen is that everyone is very into the technology, but a lot of institutions don't necessarily like the volatility. I would kind of question that, is that most people in my mind are in crypto for the idea of the volatility, the idea that number go up. But when you're talking about institutions that are trying to use this as an actual service, trying to use it as a monetary system, volatility is bad. When you don't know, saying the one Bitcoin in your bank account equals this amount in US dollars, which is the main way to pay for things around the world, and equals a different amount in US dollars the next week, that doesn't really help you in your day-to-day services.
Yeah, it's interesting. It kind of goes back to when we talk about the original promise of something like Bitcoin, right? And it being supposedly a payment system, and then over time it's very much become an asset to hold, right? Instead of being used for payments. And over the course of the lifetime of Bitcoin, you obviously had Ethereum and all these other, fantastical blockchains come about. Stablecoins really emerged as, I actually think initially they emerged more as a way to interact with and onboard, offboard to the Web3 world. So they were more like a way of parking your assets in something that holds its value, isn't exposed to the volatility. And it's kind of gone the opposite way of Bitcoin, in my opinion, because it's moved from this way of preserving your value, being a good store of value that is pegged to something like the US dollar, and is now being touted as this huge breakthrough for payments and reducing the cost of payments. So it's kind of, for me, it's had this kind of reverse story arc to Bitcoin in that sense. And now the thing everyone's really excited about, I think, is how it's going to be used to disrupt payments going forward.
I don't think that first point you made has changed. Like, I think I saw the stat was that 70% of crypto volume is still stablecoin pairs. Is that
Mm,
most of the trades that are going on are not saying between Bitcoin, Ethereum, or Solana and Bitcoin, all this kind of stuff. It's typically using some kind of intermediary as a stablecoin as an intermediary. Sorry. So if I'm trading for
yeah.
Bitcoin, I go to USDT, and then I go from that USDT to Ethereum, just because the volatility between Bitcoin and USDT is one thing. Bitcoin and the US dollar, that's how we typically measure this stuff. But between Bitcoin and Ethereum, it's a whole different ball game. So to think 70% of all trading volume in crypto is between some crypto and a stable coin.
Yeah, yeah, and I think maybe just to caveat my point, I agree with you as well that it's right now, it's in the Web3 crypto world, it is still being used for that, as the kind of the medium of exchange, let's say, between other cryptos. It's for people in the crypto world, and now I think the next phase of that is not necessarily onboarding more people into that vision, but
Mm.
it's bringing the rest of the world that isn't in Web3 currently, so the Web2 world, the old commercial world, and saying actually you can use these for payments because, again, one of the big value adds or benefits of stablecoins that's being touted now is if you compare it to something like traditional remittance payments or the
Mm.
Swift network, basically the normal payment processing rails we have when you tap your card in the shop, the huge fees you get, I mean, it's pretty ridiculous. They can range anywhere between, like, 5 and 15%, depending on what you're doing. I think the average is something like 6.22% of the transaction value ends up in
Mm.
fees, right? So when you pay for your coffee, the big chunk of that is always going to these various, 4 or 5 intermediaries who help process that payment. And now people are saying, well, actually, stable coins can be used as a much more transparent and low cost way of settling payments that don't have to go through 4 or 5 people. And I think that's where I'm seeing the excitement. But I agree, like, for the Web3 degens out there, it's still very much a bridge between other crypto things and Bitcoin, for example.
Yeah, I think it's really good to set up the problem there. And the problem is that traditional finance is slow and siloed, and it often has to go through these like big lethargic institutions, especially when it's like cross border. If I'm trying to send money from Papua New Guinea to, I don't know, the US, there's so many people that have to be involved in this kind of like trusted exchange. I don't know anyone in Papua New Guinea. My bank knows someone potentially, but they don't know the exact person. So many people involved in that, and all of them are taking a cut. Whereas, you buy into some kind of blockchain technology, you see the ledger, you trust the ledger, everyone's kind of operating in this untrusted environment per se, and they're applying that. I think I've seen this kind of described as like send money like you send email, 24/7,
Mm.
borderless, near instant and cheap. Like, it's a good narrative. It makes a lot of sense. It's kind of when you've got the stability of, fiat, which is kind of like, rough stability. It's not changing every day, but it's changing over the course of many years, obviously, combined with the technology that blockchain represents and offers, that is powerful.
Yeah, I think that's a really nice way of framing it. I've also seen, I think A16Z, I think they describe this as potentially like the WhatsApp moment of digital money, because
Mm.
what WhatsApp did for communications, it basically, instead of you having to pay fees to text someone abroad or call someone abroad, and we know how expensive that can be, that introduced essentially communications over IP on a very consumer friendly, large mass market scale. In the same way, I think this is almost like, Bitcoin and blockchain has always been money over IP, so money on the internet, a native way of transacting over the internet. And because it's happening on the blockchain, you naturally don't have those intermediaries that you described. Like when you have a card payment, it's shocking how many people are involved. There's, like, the
Mm.
bank that is issuing your card, the bank that the it's called the acquirers bank that the payment terminal uses. There's the networks, all of them taking fees, which is pretty ridiculous. And that's obviously simplified somewhat in blockchain, where you just have to submit a transaction to a network. You're paying a single fee that is a little bit more kind of transparent, and you know where it's going directly to one of the blockchain nodes, essentially. So yeah, it's definitely more elegant in the way it works, and in theory should be lower cost, which is why a lot of people are getting excited about it. And then obviously we've had, I mean, as I said, stablecoins have been around for so long now.
Hmm.
And because of all that volume, they've become some of the biggest projects, right? Like Tether, I think is the biggest, has like $150 billion market
Hmm.
cap, right? So it's huge right now. USDC or Circle, that's also become huge in the last few years. So these aren't new players either. These are quite tried and tested um, tokens now, essentially.
I think yeah. So we talked about two use cases. One is like the trading pairs, which probably isn't an obvious one. Another one is remittances, which is a bit more of a well-known one. The other one is just holding, especially in if you're in an inflation hit economy like Argentina or Venezuela or whatever it is. Like you don't want to own your native currency because of the hyperinflation, right? So you want to own something like the dollar, but you can't open a bank account to own dollar natively. So you have to say own cash. And who wants to own cash in the digital economy, especially if you're in a place where it might be easy to take said cash? So USDT and USDC, like there's such a massive opportunity there. And you touched on some of the numbers. I think the total, let's say mid 25, where we're at now, the market cap of stablecoins right now is 230 billion. Like that is huge. And one of the stats that really blew me away when I was looking at that is 27 trillion was moved via stablecoins in 2024, which is more than Visa. Like that is a
Yeah.
staggering number. Like it's crazy to think how quickly this technology has boomed.
Yeah, volumes, yeah, overtaken Visa. I think it's also overtaken MasterCard. I'm not sure which way around those two are in the order, pecking order, but yeah, it's overtaken them both now. So you're right. There's clearly a demand. Like I love the phrase that saving is using. It's something that wasn't obvious to me when I first started in this industry, because uh, I think in the UK we're not as exposed to the currency devaluation. I mean, it's getting worse, but we probably haven't seen it in the same light that other countries have around the world, and that's sort of always been an obvious use case for stablecoins, right? Just as a way of parking your assets. So yeah, that makes sense. There are other use cases, but I think maybe before we do that, we should also lay the groundwork on what stablecoins specifically we're talking about, because the word stablecoin can map onto two or three different things, right? So we have covered these in the past in
Mm.
our episode with Crypto Robbie, I think, and also a couple of other ones. But broadly speaking, we have kind of three different buckets. I think you have your fiat-backed stable coins, your kind of centrally custodied ones. You have your crypto collateralized stable coins, which are a bit more decentralized, and then you have those algorithmic stable coins that we covered with the Terra Luna collapse. So I don't know if you want to take any of those on to go through, and we can kind of go through them one by one.
I mean, the easiest one is like the fiat-backed ones. Like these are the big centralized exchanges, probably like the easiest the centralized custodians. It's the easiest to get your head around. That's what Tether does. That's what USDC does. They're the ones that are kind of going to be compliant with the new Genius Act that we'll talk about a bit later. But effectively, if I put $1 worth of money into Tether, they will mint $1 equivalent of USDT, and then that is one USDT, and I can use it, and it cycles around. You're effectively trusting that entity, that corporation, that system to mint and manage the number of tokens that are in circulation. Fairly simple. Like I remember I saw lots of things about, okay, how do we know that USDT actually has this liquid backing? Like if me and Jack each give $10 to USDT, who's actually tracking that they have $10 liquidity? I see lots of things online constantly because they've obviously have like over 100 billion in USDT in circulation right now. Who's actually checking and regulating that they have the liquidity to match that? It's always a scary thing with projects that pop up like this, especially in the kind of the Web3 world. But yeah, that's the easiest to get your head around by far.
Yeah, and I think I like them for their simplicity, right? It's kind of it's a nice blend of Web3 and the old traditional finance world, because yeah, you're not making this a fully decentralized thing. You're putting some faith and trust in the issuer of these tokens, that they, as you said, have the backing, and they have the reserves to match whatever's on chain, and the kind of mechanism that you use them with. Well, you can enter into this by putting in the US dollar amount. You get those stable coins issued on chain. And then if you want to get your US dollar out, you have to then burn those tokens typically, and the issuer will give you back your US dollars, right? So it's simple to understand, but you still have the advantage that while you're in, once you've acquired your stable coins, and you can actually use them in a plethora of anything else going on the blockchain, right? So in Ethereum, you can use it in DeFi, you can use it for payments, etc. And that, once you're in the stablecoin system, it's very transparent. You can see how things are moving, you can see how the fees are paid, and you can interact with the kind of composability of DeFi. So yeah, I think they're a nice blend of the two worlds for me in that sense.
Yeah, so that the first one is fiat backed, and then the second one, not too big a jump, is the idea of just crypto collateralized. And like the kind of the weird thing here is obviously the volatility that's actually involved in crypto. There's volatility involved in everything, but we typically use the US dollar as a base point for all value, right? So if you're using the US dollar as like fiat backed collateral, then everything's kind of relative to that. So it kind of keeps some level of stability. Crypto backed collateral, exact same. I will pay $150 worth of Ethereum into a smart contract, and then I will get, say, the equivalent of DAI, which is a stable coin made by MakerDAO. Typically, you'll over collateralize this because of the volatility involved. So rather than having $1 in, one USDT out, I will put $150 worth of Ethereum into the smart contract, and then I'll get $100 of DAI out just to try to manage the volatility involved in that. I guess the difference there is, which I think is actually quite a powerful difference, is the idea of everything's on chain. So we have accountability around, what are the liquidity levels that MakerDAO actually has in the system, where there's a degree of trust that I am transferring $1 to Tether, which often gets a lot of criticism.
Yeah, and I think it's interesting that you have that full transparency over essentially the reserves, right? Because there's no central issuer necessarily for a decentralized stablecoin, a crypto collateralized stablecoin. You can see you can see the pool of collateral on chain, you can see the mix of assets, you can see the velocity when they're being transacted. And you don't have to place that trust in a single entity. That let's say everyone wanted to go and redeem their crypto from this scheme, then they should in theory be able to get it out. But again, they're a lot more complex typically. MakerDAO is not a simple thing. It's got all sorts of different kind of bells and whistles to it. And you also then have, you're kind of mixing in a bit like, MakerDAO is an example of a DAO, right? So when we discussed DAOs previously, you have that mix of the token that you're using as a stable coin. There's typically then also a kind of governance layer to that with a governance token that decides, how the DAO operates, how the stable coin operates, therefore. So it can be a little bit more involved in that sense. But there are also implications about how the new regulations will apply, because when you're comparing something against the Howey test, for example, to see if it's a security, then you don't have a central party that you can accuse of raising funds, which is one of the key parts of the Howey test. So yeah, it's interesting. I think and they're very popular as well. They're by far the smaller of those two categories. Like there's it's in the order of single digits or tens of billions that are locked up in these protocols right now, as opposed to, we said that like 90% of the stablecoin volume and market cap is still locked in the fiat-backed version. So yeah, not as
I quite
popular
like
yet, and I'm not sure if it will be.
I get it, like from a regulatory perspective and from like a what do institutions feel comfortable with. It's obviously like maybe a step too far for them right now to kind of put money into.
Mm.
But from like a Web3 native perspective, it's ideal to see everything that's happening on chain. As soon as you have like reliance on off-chain systems, like there's a disconnect there. Like, and one of the main promises of like Web3 blockchain technology is what I see on chain, I know is real, and I can check on chain, monitor on chain, don't trust, verify, that kind of style. And as soon as we have this off-chain component, like we do in the fiat-backed systems like Tether, it always makes me slightly concerned. But when everything's on chain, obviously the main problem there is the volatility, like the management, the governance involved. And obviously institutions can't hold one entity accountable if something goes wrong, where they can in, say, the fiat-backed systems. And
Yeah,
then
and from a
finally,
purely oh, sorry, I was say, and from like a purely technology perspective, I think they're quite interesting, right? The fact that they even work is an achievement in and of themselves. And we should note this is still a case of these are collateralized. So the pegging mechanism, the way by which the tokens stay stable in value, is still based. I don't know why Alex laughing. Is still based on the value of an asset. Okay. Now the third category that we're kind of moving on to then is the algorithmic stablecoins, where there is no collateral necessarily. You do have some kind of hybrid versions, but let's just keep it vanilla and say this is essentially non-collateralized stablecoins where the peg is set and maintained by algorithms, and they've not gone too well in the past. I don't think there's that many that are still taken seriously, as far as I'm aware. I at least haven't seen them recently being taken seriously. But yeah, this is the less acceptable face of stablecoins for sure.
Today's episode is sponsored by the VeChain Foundation.
Now, we often talk about how emerging technologies like blockchain have the potential to revolutionize sustainability, and VeChain is at the forefront of this green movement with initiatives like VBetterDAO. Let's take a closer look.
Imagine tracking small actions like recycling at low cost, making them valuable assets. These verified records build a massive collective impact, benefiting people through their own actions. Sound a bit complex, but VeChain made it fun. Explore our apps at vbetter.com.
VeChain's goal is to power a new era of sustainable solutions. So if you've got an app idea or just want to earn rewards for small, sustainable actions every day, go check out vbetterdao.com to find out more. And now, back to the show. And I guess what's the simplistic version of explaining this? Like, my understanding is you typically have two assets and you're kind of maintaining the price point of one asset by burning and minting and matching to the other asset, right?
Yeah, exactly. They have there are a bunch of different ways of doing it. I think they have like the constant product curve. So yeah, you have to keep the balance of the assets in the pool, those two assets along this curve that mathematically should keep the price the same. There are more complex versions than that, but one of the key points is these typically need to have huge liquidity to make sure that the price um, isn't moved too much by big movements in and out of those liquidity pools. So as we saw, when these things fall off the peg, it's very difficult to get them back on, which is exactly what happened with the Terra Luna collapse, which I can't believe is nearly 3 years ago, over 3 years ago now, which wiped off 40 billion in market value from that project. And I don't think algorithmic stablecoins have really recovered for that. And to be honest, I'm not mad about it. Again, mathematically interesting, but I think a little bit too Wild West for me to get involved with.
Yeah. And another project that I think is worth mentioning, when we're going from, the pure techies to institutional adoption, is the fact that PayPal have moved into this space as well. They've offered their own stablecoin. It's the first big tech stablecoin, I guess you could say, and it's integrated into PayPal, which is obviously one of the most used payment services in the world. Like, I use PayPal. I think it's such a great user interface and like supported absolutely everywhere. And again, quite traditional, fiat-backed, one-to-one. It's what's the ticker, Pi USD, PayPal USD or something like this. But it's crazy to think of institutions, big traditional payment institutions, offering stablecoins.
Yeah, and I think this is an interesting thing, right? Because it was launched a couple of years ago now, maybe, or 18 months or something like that. But this, for me, this really validates what we said at the beginning, is there is a big problem in traditional payments processing, and the big institutions know that. They know that there's a lot of fees and a lot of kind of money being left on the table for the consumers, the merchants, and all that. So I think they know that this is going to be solved in some way by technology, probably by stablecoins. So PayPal clearly trying to get a little bit ahead of the curve on that, in my opinion. They're saying, well, we may as well be involved in this system as best we can. Let's have people use our stablecoin so that they're not ending up using, a different one that we have absolutely no stake in if everything goes towards this model of payments in the future. So I think, yeah, it's a good data point to validate that actually, one, there is a problem there that can be solved, and that the institutions are really taking that seriously as a tech means to solve it.
Yeah, that makes sense. I think I kind of always thought of PayPal as being like a disruptor of traditional banks and traditional payment systems, but they're not really. Like, they still use the same payment rails. Like, they suffer from the same problems as traditional payments. If you're sending things cross border, you'll often have to go through the same correspondent, banking systems as, say, the Santanders, the Barclays of the world, and this still means delays of 1 to 3 days, and even more charges on those payments. So yeah, it makes sense that they're slightly more innovative and slightly more disruptive than, say, your Santanders of the world, but not so disruptive that they can, send payments from point one to point two without having many people involved. So yeah, it's quite nice to see them jumping on this. And I think it's a really interesting step to see that we have big regulated institutions going into this space and offering, say, more institution friendly, regulatory friendly products in the space as well. It's always good to have competition.
Yeah, and it's a good, obviously, as you said, a signifier that the institutions at large are getting involved. Like no one's really gone anywhere near as far as PayPal in this respect yet, but you are seeing, even this week in the light of the new, legislation passing through in the US, lots of the kind of big major investment banks, your JP Morgans, are starting to talk much more openly and freely about this. I know JP Morgan, they have something that is not a stable coin, but it's a kind of collateralized deposit token that you can use in a kind of JP Morgan ecosystem, which is,
Mm.
works in principle a little bit like a stable coin, but I don't think would fall under that category. But, they and a bunch of other banks are talking openly weekly at, fintech conferences, some at crypto conferences now about their plans. So I think, yeah, it's only a matter of time before we see many, many more institutional stable coins launched.
Revolut. I've seen Revolut are planning one. I don't know if they
Mm.
announced the release date yet. I think they were saying this year or next year, but a similar vein to PayPal, highly regulated, one-to-one traditional fiat-backed. Now, there's a thing. I don't think it's actually that tricky to do these things, and there's a massive monetary incentive to do so. Like they're looking at the numbers that are playing. Like so many of so much of banking and payments is dominated by two big players, Visa and Mastercard. And as soon as you're offering a new way of effectively disrupting all of that, like in these stable coins, and no big institutions being in that space apart from PayPal and now potentially JP Morgan and Revolut, it's obviously a huge opportunity. Like it'd be crazy for some of these more tech savvy financial services and banks to not jump into this space as quickly as possible. I'd be surprised if we don't see like Monzo go into the space, to Starling go into space. The tech savvy banking systems are going to push heavy and try and be, the new US dollar.
Yeah, and like another example of like a disruptor, tech focused disruptor would be Stripe. So they have always been quite crypto friendly. They were a long time ago offering kind of crypto payment services, and then shuttered it for a while, in the dark crypto winters that we've had, and now are kind of back with, very pro stablecoin stance. That they've always been seeing themselves as a disruptor to make payments on the internet much more like email, much lower cost, low friction. So, they're another one that's talking about providing rails for the stable coins as well, which is really interesting. And I think we're also not just in terms of people getting involved, but if you look at the big stable coins you mentioned, like USDC, Circle, we're seeing them also starting to really, work quite cooperatively with the legislators. So in Europe, for example, I think Circle is now the very first MiCA compliant stablecoin issuer in Europe in general. So obviously MiCA came in again a couple of years ago now and provided some legislation on the requirements, like being an electronic money institution, I think it's called, to be an issuer of stablecoin. So Circle have had that compliance. They've met that threshold there, and you think what's happening in America now will mean everyone will have to follow suit eventually for that.
Yeah, and I guess the MiCA compliance is, I think, under talked about now. Like we're
Mm.
obviously based, well, we're in the UK, but I still consider us European, which may be a bit controversial. But this is all about what services can be offered, right? What cryptos can be offered, what stable coins. If you're not MiCA compliant, then you can't buy, sell, operate in the EU. So, like, I think a lot of people have said that the regulations are quite stringent and very difficult to keep on tabs with. Like, for example, Tether have just said we're not going to be MiCA compliant, so it's now not going to be an option to support Tether in the EU, which I think is crazy, right? But to see that Circle is obviously pushing down that route is, one, good for the EU to know we do have a strong stablecoin in the space, but also very impressive that they managed to stay on top of the regulations and done it so quickly, because it's only announced like last year.
Yeah, exactly. And there's also been a few examples, I think, of let's just cast our minds outside of the crypto space in general, but there are lots of companies who are starting to look at using stable coins for just kind of day-to-day things like salary payments. So this company Scale AI, I think, is the one that has caused a few ripples with the Meta acquisition. I think they acquired like 49% or something of them, and they are using stable coins for salary payments and things like that. So it's definitely, especially from tech focused firms, they're starting to offer that. I'm sure there's also a bunch of crypto companies who are paying their staff in things like USDT, USDC for the same reason, that they can have remote workforces. They get paid in something that's pegged to the US dollar. So it's very convenient, especially for remote workers, I think. So I think we've danced around, getting into the details here enough. So let's finally do it. So yeah, in the US, there's been these big developments recently. Genius Act was passed, sworn into law just last week. The Clarity Act is coming up. So let's go through what both those mean and what the implications are. So the Genius Act is specifically for stablecoins. So it's an acronym, as everything always is. Genius is an acronym on guidance ending in S, stablecoins. And this essentially, so it's now passed through into law. This provides new requirements that didn't exist before. It was in this kind of regulatory gray area for the issuers of stablecoins. So, for example, they need to be licensed by state or federal regulators. The stablecoins themselves need to be backed one-to-one by fiat currency or short-term treasuries. So this is, again, applying to that first bucket of stablecoins we mentioned. This is why I kind of think we needed to lay the groundwork there. But this is very much your USDTs, your USDCs that we talked about. It makes sense. They're like the biggest by a mile. They cover 90% of the market. So this, it makes sense that they're regulating for that specifically. Plus, they're the ones with the known entities behind them. You have a real world entity who you can hold accountable for the operations, the reserves, treasury management of those stablecoins. So yeah, this is a really landmark moment because for years people have been worried, I think, about how the government would regulate these things, and this is generally being seen as a kind of positive pro innovation approach, right, to stablecoins, saying, yeah, we get the value, we understand this is very useful for all the things we've said. Here are the rules for you to comply. Great. And I think the industry is obviously receiving that very positively.
Well, I think Circle, obviously USDC, the second biggest stablecoin, is very supportive of this. They, I would say, of the two, are probably the more regulatory friendly overall. Like we said already, they're MiCA compliant. Tether, again, I don't know if they've come out and responded to this yet, but there's a lot of pressure on them to comply. Again, lots of people are constantly talking about they need to prove their liquidity. They need to prove that they have this backing that they say they have. And this, obviously, when they become compliant, will justify this. And I think add a lot of security to the market and to Tether generally. The next big one is the Clarity Act. I think this is kind of slightly boring. It's the classic conversation we've been having over the course of years. It helps distinguish tokens as commodities versus securities, SEC versus CFTC versus BYD, all these crazy acronyms that are constantly going on. But it's all about developing a clean legal framework for tokens, exchanges, and developers to know how things are being taxed, how things are being regulated. It's just a bit more certainty and clarity for the companies that are developing and using this stuff.
Yeah, in some ways, to me, it's bizarre that we got regulation on stablecoins before, the general classification of tokens and who is responsible for them. I understand why, because stablecoins are kind of much easier to pin down and simplistic, especially as they're, talking primarily around fiat-backed stablecoins. But yeah, it seems bizarre to me that we still technically don't have the laws and the rules laid down around what is a security, what is a commodity, which parts of the Howey test, who's responsible for regulating them. It's crazy. But yeah, so this one has passed the first phase. It's gone through House of Representatives, and then we'll go through the Senate. And if it passes again, we'll then be sworn into law. So yeah, I still think it's exciting because this really. It's weird because it's kind of just setting the playing field and saying, okay, the industry can really start now. It's instead of being, we've talked in the past about all the companies moving abroad to different jurisdictions that have been, I guess, more regulatory lax, but also just quicker to define what they're willing to accept. And either way, I think from both of these two pieces of legislation, the big winners will end up being the consumers, the everyday people who are, touching and using these assets. Because at least people will be held accountable for their operations. I think especially with the Genius Act, that being stablecoin specific, I think the real winners can only be the consumers here, because it means that any of the stablecoins you already own or have been issued in the past will now potentially fall under that regulation, and you'll have much more confidence, hopefully. And again, this has always been the issue, is how well backed are these reserves? We don't really know. There have been sort of kind of audits and things, but there's questions over those always. So I think, yeah, having a much stronger requirement to report the financials of these treasuries and audit these on a more regular basis is just going to improve consumer confidence. People can just use them without so much worry about whether you can redeem everything if you need to.
Yeah, I think it's a powerful thing for the US and quite a smart move as well, because obviously USDC and USDT, they're backed one-to-one with the US dollar. So it kind of just reinforces the idea of the dollar being this global kind of underpinning monetary store of value, or the underpinning peg for everything. So if they kind of mandate that to operate as a stable coin in the US specifically, which is still the global dominant market force, then you need to have a peg. And I think it's actually pegged to either cash or treasury bills, right? So that kind of naturally will peg it directly to the dollar. So they need to have these liquidity reserves of the dollar. So yeah, it's a smart move for them. I think the one final thing they want to talk about in these acts is the anti-CBDC Act. So we've had a lot of talk, especially with the current administration, around CBDCs, about the efficacy, about support versus not support in the EU, and a lot of, say, less economically developed countries as well. Like, support for CBDCs and development of CBDCs is really pushing ahead. There's a lot of countries that have advanced CBDCs or are in the later stages of CBDCs, but the US has come out completely anti it. I think for one obvious reason is because the dollar is still the global reserve, and maybe they don't feel the need to, whereas other countries want to jump ahead and they have much more in remittances or whatnot. But the other one is lack of trust in government, probably as well, is they don't trust the idea of CBDCs because a lot of people think that it's just a mechanism for the government to control and basically get all the private information of the individuals using it. But this, the Anti-CBDC Act formally bans federal issuance of a retail digital dollar, which I think is extremely powerful and really sets the message. I'd be interested to see what happens around the world and if other governments follow suit after this.
Yeah, I think America has for a long time, and it makes sense, right? That the kind of the very pro freedom and liberty stance of America generally. It's pretty much always had the most resistance, as far as I can see, to a CBDC. So it makes sense that this anti CBDC bill is also being touted at the same time. It's not one I've kept as close an eye on because I've honestly haven't thought about CBDCs very much recently. They've been out the news. They're not the hot thing anymore, partly because those countries that are taking it seriously have, as you said, advanced to a certain level. Those countries that aren't talking about it anymore. And yeah, I think it's one. It'd be interesting to see what the actual voting numbers are on that bill in particular when it goes through, and just how strong the sentiment is. But either way, it's a very powerful message being sent with that one.
So yeah, it's quite obvious that the US is doubling down on private sector stable coins as a digital dollar alternative, which makes sense. Like I say, all these private stable coins are backed 1-to-1 with the US dollar, so why not just support those and let them go? They obviously already have the market cap. It's less work for the US Treasury that a lot of people don't trust anyway, so it makes sense for them. And this gives the green light to regulated innovation in a lot of ways, which governments typically aren't very good at. I think it's often good to think about the spectrum of crypto to stablecoins to CBDCs. And although the US isn't pushing CBDCs, there will be CBDCs launched around the world. And it'd be really interesting to see how they play out and how they match up versus stablecoins. Like, my typically really simplistic view of the three is that a CBDC is a government issued currency that is digital and typically on a ledger. Stablecoin is just a privately issued currency that is typically on a ledger, and then crypto is a decentralized issued currency that is on a ledger. And I think that's the most simplistic view. And when you kind of take that approach, we typically see that innovation on crypto is far more advanced because anyone can contribute. It's open protocols. So like you're seeing like absolute revolutions in cryptos like basically every other week. Whereas stablecoins is much more conservative, but still more innovative than whatever a CBDC is. So from like the innovation perspective, crypto is the most advanced and CBDCs are the least, with stables and somewhere in the middle. And then in terms of like regulatory friendliness, it's the complete opposite. CBDCs are obviously the most regulatory friendly because issued by governments, stablecoins somewhere in the middle, and crypto is the least by far. I think I kind of like to think of it as a spectrum, and you kind of work out where you want to play in that. And there's probably a space for all of them to kind of grow and be used. It's just what are the use cases?
Yeah, for sure. And I think in all that's a really nice way of outlining what the spectrum is. I think what we've seen now with these three pieces of legislation going through in America is the US putting its stamp on exactly where it is in that spectrum. Because if you think about CBDCs, that is arguably the most beneficial to a given government, right? It can give them the most control and power, and that can be taken to an authoritarian scale or not, right? But it is arguably most in favor of the government. Whereas the US is a special case for stablecoins because so much of the market cap of stablecoins is US dollar denominated. So it's like for me, it's them taking it themselves down this path of saying, well, we want to be pro the US dollar and we want to be pro our own economy, and seeing stablecoins as actually the better option, the better route to do that. Because if you think about it, I think you mentioned earlier, but wide proliferation of US dollar denominated stablecoins just gives access to potentially hundreds of millions, billions of people worldwide, gives them exposure to and increases demand for the US dollar without them needing to have a US bank account. So it's essentially opening the global market for dollars, which I think could end up being a very, very smart move in their part.
Yeah. And then you look at countries saying, like China, for example, and they're never going to back crypto or a privately issued stablecoin. They want CBDC because they want full control, for good or for bad, whatever you say. It's really interesting because, like, the kind of thing that's touted in the US is typically we don't trust government, we don't want money being tracked and the taps being turned off. But they trust private companies more so. It's like, who is Tether to them? Like, Tether could be doing the exact same things, and they would trust that private entity more than their own government. It's really interesting. Like, they're libertarians and anti-government in a lot of ways. They want individual controls, but that's fine when it comes to private companies. They're very happy to relinquish controls to private companies. So it's kind of like I'm always torn between whether it makes the American dream, baby, the American dream. Yeah, it's an interesting one.
Awesome. Well, yeah, I think that pretty much does it. I think we've covered, the big news, obviously, in the stablecoin world, and I think this is very much marking a big moment and hopefully a turning point on this journey for crypto in general. I think this is a big moment for institutional. Yes, go on.
Is crypto still the end goal, or do you think that stablecoins will always be around? Like, is this just a stepping stone on the journey to crypto adoption full scale?
This is probably one of the biggest steps crypto can make to go mainstream in general, because, as you said, the likes of your PayPal's getting involved. They are going to be bringing huge existing customer bases and letting them interface directly with crypto, even if it's not packaged up as crypto and if it's just packaged up as this new digital form of money. But I think this is probably the easiest on ramp there's ever going to be for crypto in general, right? And I think that could only be a good thing. Like, it's going to be the tide that rises all ships eventually. I wasn't, we used to be probably idealistic and think that maybe just the promise of Bitcoin and the promise of crypto for payments and things might win out, but actually it's showing that there is a strong incentive for the old players to play ball with the crypto infrastructure in general. And I think, an example would be with Circle. They've built out an entire cross-chain transfer protocol just to make sure they're maximizing how many chains you can use USDC on, right? So you've now got these players who are actively contributing to infrastructure in Web3 just to kind of make sure their stablecoin is the best and the most used. So I think, that's the direction of travel for me. So yeah, I think this is, crypto is still the end goal, because I think there's more value to be had in the sum of all parts, but not all crypto is the end goal, as always. I think a very small slice of it.
I get you. And competition in stablecoins is definitely good. So it's nice to see lots of players working in that space. I agree with you. I think that right now, the only problem with stablecoins versus crypto is the instability and volatility associated with crypto. But if we see more adoption, more institutional backing, less retail focus, potentially, hopefully that volatility will go away. Eventually, I imagine a world where crypto won't be measured versus US dollars. It'll be measured versus what you can buy or other crypto or whatever it is. And we'll see Bitcoin as, yeah, exactly. Sheep. We'll go back to sheep, baby, in Wales. Like, Bitcoin might be the thing that we match things against, other cryptos. And Bitcoin is almost certainly not going to be that global payment system or the global payment currency. It's too slow now. They've kind of made that decision. But it would be interesting and exciting to see if a crypto can fill that gap, because I would much more trust a decentralized system over a private issuer that's pegged against a currency that can be inflated whenever they want, So that's my goal anyway, or my hope at least.
And on that bombshell, it's time to end. I think, thank you for listening. If you're still with us, I hope you enjoyed that deep dive into stablecoins. There was more to say than I ever expected, but yeah, thank you for listening, and you can join us next time to untangle a little more Web3.